If your investment portfolio feels complicated, there's a good chance it's underperforming. Too many funds, too many opinions, too many predictions, and not enough clarity. In 2026, investing has become noisier than ever. Social media experts promise 10x returns. Financial headlines swing between panic and euphoria. One week it's AI stocks, the next week it's recession fears. Then it's interest rate speculation, then geopolitical risk. And in the middle of all that noise, regular investors are trying to make smart decisions for their future. Here's the uncomfortable truth. Most portfolios are not failing because of bad markets. They're failing because of bad structure. Over-diversified, under-diversified, overexposed to one theme, too defensive, too aggressive. The problem isn't effort, it's design. After the volatility between 2023 and 2025, rising interest rates, inflation spikes, equity pullbacks, bond market adjustments, many investors realized something important. They didn't actually know why they owned what they owned. If I asked you right now to explain your portfolio in one sentence, could you? If you have more than 5 ETFs, several individual stocks, a little crypto, maybe some hot tip positions, and you're not completely sure how it all works together, you're not alone. But you don't need 15 positions to build wealth. You need structure. In this video, I'm going to show you the only 3 investments you truly need in 2026 to build long-term wealth in a simple, stable, and scalable way. No hype, no stock picking competitions, no prediction games. Just 3 foundational assets that have survived inflation cycles, recessions, bull markets, rate hikes, and global uncertainty. And more importantly, 3 assets that work together. Because investing is not about finding the best performer this year. It's about building a system that performs across decades. If you're in your 20s or 30s, this structure can eliminate years of confusion. If you're in your 40s or 50s, it can simplify and stabilize your portfolio. If you're approaching retirement, it can reduce risk without sacrificing growth entirely. Before we go deeper, I want you to do something simple. Comment below how many different investments you currently own. Be honest. If it's more than 5, ask yourself, do I need all of them? Clarity reduces stress. Simplicity increases consistency. And if you value practical, calm financial strategies for 2026 and beyond, subscribe to Finn Explains Money. This channel is built on structure, not speculation. Now let's break down the only 3 investments you actually need and why they work. Let's start with a principle that most investors ignore. Every portfolio must solve 3 problems: growth, stability, and liquidity. If your portfolio only focuses on growth, it becomes emotionally unstable during downturns. If it only focuses on safety, it loses purchasing power to inflation. If it lacks liquidity, you are forced to sell investments at the worst possible time. The reason most portfolios feel chaotic is because these 3 roles are unclear. So instead of thinking in terms of hot sectors or trending assets, we think in roles. Each investment must serve a purpose. The first role is growth. And in 2026, the most efficient way to capture long-term growth is broad market equity exposure. Not individual stock picking, not concentrated bets, broad exposure. This means owning a low-cost total market index fund, or ETF, that represents a large portion of the stock market. Why? Because over long periods, global businesses grow, productivity increases, innovation continues, profits compound. Yes, markets fluctuate year to year, but over decades, broad equity exposure has historically outpaced inflation and built wealth. From 2023 to 2025, investors experienced volatility driven by interest rate normalization. Growth stocks corrected, value stocks rotated,
International markets moved differently than domestic markets. Those who owned concentrated positions felt stress. Those who owned broad index exposure felt fluctuation, but not chaos. The power of a total market index fund is simplicity. Instead of betting on which company wins, you own the system. You capture the average return of the market at very low cost. Costs matter. An expense ratio difference of even 0.5% compounded over 20 years can reduce final wealth significantly. Low cost equals higher retained return. Now, some people ask, isn't owning the whole market boring? Yes, and boring is powerful, because investing is not entertainment, it's capital allocation. The second role every portfolio must solve is stability. Between 2023 and 2024, bond markets experienced sharp adjustments due to rapid interest rate increases. Many investors who thought bonds were safe saw temporary losses. This created confusion. But here's what changed in 2026 compared to the ultra-low rate era of the early 2020s. Bonds now yield meaningful income again. When rates were near zero, bonds offered little income cushion. Now, high-quality government and investment-grade bonds provide yield that can help stabilize portfolios. Bonds serve two purposes. They reduce volatility. They generate predictable income. When equity markets decline sharply, high-quality bonds often hold value better. Not always, but historically with lower volatility. Stability allows you to stay invested in growth assets during downturns. Without stability, investors panic and sell equities at lows. So the second essential investment in 2026 is a high-quality bond fund, broad, diversified, low cost. Not speculative credit, not high-risk corporate debt. High-quality exposure. Now let's talk about the third role, liquidity. Liquidity is underestimated. Liquidity means having accessible capital that does not fluctuate with the market, cash or cash equivalents. Why is this critical? Because without liquidity, every unexpected expense becomes a forced investment decision. Car repair? Sell stocks. Medical expense? Sell stocks. Job instability? Sell stocks. And if that sale happens during a downturn, you lock in losses. In 2026, with economic uncertainty still present in many sectors, liquidity provides flexibility. High-yield savings accounts, short-term treasury funds, or money market funds now offer reasonable yields compared to the near-zero rates of the past. Cash is no longer dead money, it's optionality. Optionality reduces stress. So the three investments are not exotic: broad market equities, high-quality bonds, cash or cash equivalents. That's it. Now the magic isn't in owning them, it's in how you allocate them. Allocation depends on time horizon and risk tolerance. If you are in your 20s or early 30s with a long investment timeline, your allocation may lean heavily towards equities, perhaps 80% or more, with smaller allocations to bonds and cash. If you are in your 40s, you might moderate that to 60 to 70% equities, increasing bond exposure for stability. If you are approaching retirement, equity exposure may decrease further, with bonds and cash providing income and protection. The point is not to find the perfect percentage. The point is to ensure all three roles are covered: growth, stability, liquidity. Now, let's address a common objection. What about real estate? Real estate can be a powerful asset class, but for many investors, primary residence exposure already creates significant concentration. Investment property adds complexity, leverage risk, and liquidity constraints. The three investment structure we're discussing forms the core. Additional assets are optional layers, not replacements. Another objection: what about international diversification? Broad market index funds often include international exposure or can be paired with a total international fund to maintain global balance. The idea is not to ignore global markets, it's to maintain simplicity while capturing diversification. Now, let's talk about behavior. The biggest threat to investment success is not volatility, it's reaction. During the 2023 downturn, many investors sold equities near lows. During rallies, they bought aggressively at highs. This reduces long-term return. A simple three-asset portfolio reduces decision fatigue. Instead of constantly adjusting positions, you rebalance periodically, perhaps once a year. If equities outperform and grow beyond target allocation, you trim slightly and add to bonds or cash. If equities underperform, you add slightly to restore balance. Rebalancing forces you to buy low and sell high systematically. No predictions required. Now, consider the emotional difference between a 100% stock portfolio and a balanced one. In a severe downturn, a 100% equity portfolio might drop 30% or more. A balanced portfolio with bonds and cash may drop significantly less. That difference can determine whether you stay invested or panic. Staying invested is more important than maximizing short-term return, because compounding requires time in the market, not timing the market. Let's quantify something simple. If you invest consistently for 20 years with an average return of 7%, your money roughly quadruples. If emotional mistakes reduce that return to 5%, your outcome is dramatically smaller. 2% matters. Behavior drives that difference. Simplicity protects behavior. Now, how do you implement this practically? Inside retirement accounts, choose low-cost index funds covering total market exposure and high-quality bond exposure. In taxable brokerage accounts, prioritize tax-efficient equity index funds and maintain cash separately in high-yield savings. Avoid constant trading. Automate contributions. Set a schedule. The less you interfere, the better the system works. The beauty of a 3-investment portfolio is scalability. As income increases, you simply increase contributions proportionally. No need to search for new ideas. No need to chase trends. Just scale. And as net worth grows, the same structure continues functioning. Many high net worth investors use variations of this exact framework because complexity increases risk of error. Now, let's connect this to 2026 specifically. Interest rates are no longer artificially suppressed. Bond yields provide meaningful income. Equity valuations have adjusted from extremes. Inflation, while moderated, remains a long-term consideration. In this environment, balanced portfolios make sense. Overexposure to one asset class increases vulnerability. Diversified simplicity increases resilience. And resilience allows you to continue investing regardless of headlines. Because headlines will not stop. Markets will fluctuate. Predictions will conflict. But structure endures. This 3-investment model is not about maximizing excitement. It's about maximizing probability. Probability of staying invested. Probability of compounding. Probability of reaching financial independence with less stress. When investing feels boring, that's usually a sign it's working.
Owning the right 3 investments is only half the equation. The other half is understanding how to operate them correctly, because even the simplest portfolio can fail if the rules around it are inconsistent. Let's talk about how this structure behaves across different economic conditions and why that matters in 2026. First, imagine a strong bull market. Equities surge. Headlines are optimistic. Your total market index fund climbs steadily month after month. Social media fills with stories of quick gains. Friends talk about specific stocks that doubled. In this environment, the temptation is concentration. You start wondering if your diversified index fund is too slow. This is where the structure protects you, because the goal isn't to win a single year. It's to build wealth across decades. When equities rise sharply, your allocation naturally drifts upward. If your target is 70% equities and the rally pushes you to 78%, rebalancing forces discipline. You trim slightly. You move the excess into bonds or cash. That action feels counterintuitive during excitement, but it prevents overexposure at peak valuations. Now imagine the opposite environment. A recession hits, corporate earnings decline, markets fall 20% or more, headlines predict prolonged downturns. This is when panic behavior typically appears. If you are 100% equities, your portfolio drop feels severe, but if you hold high-quality bonds and cash, something different happens.
Your bond allocation likely holds steadier or declines less sharply. Your cash remains stable. The overall portfolio drop feels more manageable. That psychological difference is critical because when downturns feel survivable, you stay invested. And staying invested is what allows compounding to resume when recovery begins. Between 2023 and 2025, investors experienced both sharp rallies and sudden pullbacks. Those who had balanced portfolios had smoother emotional experiences. Smoother emotion leads to better decisions. Now let's talk about allocation more specifically. There is no universal perfect percentage, but there is a framework. Start with time horizon. If you need the money in less than 5 years, heavy equity exposure introduces risk of timing losses. In that case, bonds and cash dominate. If your time horizon is 10 to 20 years or longer, equity exposure becomes the primary growth engine. But even long-term investors benefit from some bond allocation, not because bonds maximize return, but because they reduce volatility enough to protect behavior. A common rule of thumb used historically was 100 minus your age for equity allocation. In 2026, many advisors modify that slightly due to longer life expectancy and extended working years. But rules of thumb are just starting points. Risk tolerance matters just as much as age. If a 25% market drop would cause you to panic sell, you are overallocated to equities. Portfolio design must reflect behavior reality, not theoretical courage. Now let's address inflation more specifically. Inflation erodes purchasing power silently. Cash alone loses value over long periods. Bonds may struggle during sudden inflation spikes. Equities historically have provided better long-term inflation protection because companies can raise prices. This is why growth assets remain essential. But holding some bonds and cash allows flexibility when inflation volatility creates uncertainty. In 2026, inflation has moderated compared to its peak earlier in the decade, but long-term inflation expectations remain relevant. A diversified portfolio balances inflation resilience with stability. Next, let's discuss sequence of returns risk, especially important for those approaching retirement. Sequence risk refers to the danger of experiencing major market losses early in retirement while withdrawing funds. If you retire with 100% equity portfolio and markets drop 30% in your first year, withdrawing from that reduced balance locks in losses. This is where bonds and cash provide protection. By holding several years of expenses in bonds or cash equivalents, you can withdraw from stable assets during downturns and allow equities time to recover. This dramatically improves sustainability. The 3 investment structure naturally supports this strategy. Now let's talk about implementation details more specifically. Within tax-advantaged accounts like retirement plans, holding both equity index funds and bond funds is straightforward. In taxable brokerage accounts, equity index funds are typically more tax-efficient than bonds because bond interest is taxed as ordinary income. Many investors choose to place bond exposure inside tax-advantaged accounts and hold equities in taxable accounts. Cash or high-yield savings is typically separate and used for emergency reserves and short-term needs. Tax efficiency enhances net return over time. Again, simplicity matters. You don't need to constantly rotate between sectors or guess interest rate movements. Instead, you maintain strategic allocation and rebalance periodically. Rebalancing frequency does not need to be monthly. Once per year is sufficient for most long-term investors. Some prefer threshold-based rebalancing, adjusting only when allocation drifts beyond a certain percentage. Either method works. What matters is consistency. Now let's address the psychological trap of comparison. In any given year, one asset class will outperform others. During strong equity years, bonds may appear useless. During equity downturns, cash may appear smart. The mistake is abandoning balance based on recent performance. Diversification means always owning something that underperforms in the short term, but the purpose of diversification is not to maximize short-term gain, it is to reduce long-term risk of catastrophic loss. That trade-off is worth it. Now let's examine risk more realistically. Risk is not volatility alone. Risk is the permanent loss of capital. High-quality broad index funds reduce company-specific risk. High-quality bonds reduce default risk. Cash eliminates market volatility for that portion of assets. By combining them, you reduce the probability of permanent damage. In 2026, global markets are more interconnected than ever. Geopolitical events, trade disruptions, technological shifts, all create uncertainty. The best response to uncertainty is not prediction, it is diversification. Now consider the investor who tries to hold 10 or 15 thematic ETFs, AI Technology Fund, Clean Energy Fund, Emerging Markets Fund, Dividend Fund, Small Cap Fund, Real Estate Fund, Cybersecurity Fund. At some point, complexity becomes overlap. Many thematic funds hold similar underlying companies. This creates an illusion of diversification while increasing concentration risk. A total market index fund already captures exposure across sectors. Adding too many specialized funds often increases cost and behavioral temptation without meaningfully improving diversification. Simplicity reduces overlap. Lower overlap reduces hidden risk. Now let's discuss fees more specifically. Even small expense ratios matter. If your equity fund costs 0.05% and another costs 0.75%, the difference compounds over decades. On a $500,000 portfolio, that difference can amount to tens of thousands of dollars over time. Low-cost funds preserve return. This is why the Simple 3 approach focuses on broad, low-cost exposure. Costs are one of the few variables you can control. Now let's talk about contribution strategy. Consistency matters more than timing. Investing monthly through automatic transfers reduces the impact of short-term volatility. Dollar-cost averaging spreads purchases across market cycles. It also removes emotional decision-making. In 2026, with digital platforms and automated investing tools widely available, there is no reason to rely on manual timing. Automation increases discipline. Another advantage of a simple portfolio is clarity in goal tracking. If you know your expected long-term return range based on historical averages, perhaps 6 to 8% depending on allocation, you can model potential outcomes. You can estimate how much to invest monthly to reach a target by a certain age. Clarity improves motivation. Complex portfolios make modeling difficult. Now let's address the role of real estate more directly. For many individuals, primary residence represents a significant asset. That alone may account for a large percentage of net worth. Because real estate is less liquid and concentrated geographically, it increases exposure to one asset class. In that context, maintaining diversified financial investments becomes even more important. If real estate markets weaken, diversified equities and bonds may provide balance. Again, roles matter: growth, stability, liquidity.
Real estate often lacks liquidity and is concentrated. Financial portfolios provide flexibility. Now consider economic slowdown scenarios. If unemployment rises and job security feels uncertain, cash reserves become critical. Holding sufficient liquidity allows you to avoid forced sales. It also allows you to maintain contributions when others cannot. In downturns, those who continue investing often benefit most during recovery. Liquidity enables that. Now let's look at extreme optimism scenarios. During speculative bubbles, concentrated portfolios may appear superior. Friends may boast about outsized gains. Resisting that temptation requires confidence in structure. Remind yourself, long-term wealth is built on probability,
not excitement. Most investors who chase performance end up buying high and selling low. Structure reduces that pattern. Finally, let's talk about scaling over time. As your income grows, you don't need new asset classes. You simply increase contributions. As your net worth grows, allocation percentages may shift gradually towards stability if retirement approaches, but the core structure remains intact. The simplicity of 3 investments reduces maintenance. Maintenance reduction reduces stress. Lower stress increases adherence. Higher adherence increases long-term success probability. In 2026, information overload is a real problem. You can access thousands of investment opinions instantly, but more information does not equal better outcomes. Better outcomes come from consistent execution of a simple, proven framework. The 3 investment structure works because it covers essential roles. It adapts to different life stages. It survives market cycles. It reduces behavioral mistakes. And most importantly, it frees mental energy. Instead of constantly analyzing markets, you focus on increasing income, controlling expenses, and maintaining contribution rates. Those variables matter more than picking the perfect ETF. When your portfolio feels calm, your financial life feels calm, and calm investors stay invested. Stay invested long enough, and compounding does the rest.